David, higher for longer. Is this a market that has accepted that, do you think, or does it need that messaging from the Fed today?
Well, I don't think the Fed can really give that messaging with any certainty because, people talk about a soft landing, but the truth is the economy never lands. I mean, you've always got another quarter, and sooner or later, winter is coming. We don't know when winter is going to arrive, but it will eventually arrive. Eventually, we'll have a recession. Eventually, we'll have a month or two where payroll gains are negative. And at that point, the Fed's going to have to cut rates. We think probably get through 2023, but sometime in 2024 that could well happen, and then the Fed has to cut. And by the way, when the Fed has to cut, the first cut will do nothing to help the situation. What we've always seen is that when the Fed raises rates, it's kind of like going up an escalator, and when they cut rates, it's like going down an elevator. And so the Fed, their own projections say they'll be able to bring rates back down to their neutral rate very slowly. Never happened. So I think the market may be looking at that. They realize the Fed's being very aggressive right now, but they won't be very aggressive forever because a landing won't stay soft forever.
What is as you look at where stocks are today and where they've come, as Melissa points out, 5 percentage points higher than at the last meeting. What do you think the path for stocks is over the next 6 months?
Well, I look at valuations a lot, and I do worry about the mega cap stocks that have really led this charge. But overall, I think it could be pretty good because the key point is eventually inflation is going to get back down to where we were in the last decade. It's going to get back down to 2%. Eventually, the Fed's going to have to react to a recession and cut rates back down again. And so you get back into a slow growth, low inflation environment in which companies are very good at maintaining margins. I mean, that's the other message from the earnings reports that we've seen so far this month. There's a problem on revenues, but they're doing a great job of maintaining margins. And I think U.S. companies could do well in a cold climate. And I think I think the stock market is taking some comfort from that.
Do you want to continue to be in the parts of the market that had not participated in the first half of the year that have just shown signs of life recently?
Yeah, I do. Because if you run into a bump in the market, a problem, the very things that got the most air under them are going to fall the most. So I'd rather look at valuations very carefully right now because at some stage we're going to have some turbulence, and I wouldn't want to be in the overpriced stocks at that time.
But the tech stocks, the large cap tech stocks, have been viewed as defensive. When SVB happened, money went into the large cap tech stocks. That's no longer the case, you think?
Well, it's admittedly the problem this time around will be a worry about recession rather than about inflation. But I still worry about valuations because if you have a market correction, a significant market correction, people are worried, they'll start looking at valuations. And so I still keep an eye on valuations, both here and abroad, where valuations are much cheaper.
So the choice sectors of the market from where you sit are?
Well, I'd be a little overweight international. I think industrials can do reasonably well here. I like financials if you can get through this cycle, because eventually you're going to have this upward sloping yield curve. Right now, a prolonged downward sloping yield curve is not good for financials, but eventually this thing is going to flip because, as I say, soft landings don't last forever.
Let's not pound the table, though. I mean, do treasuries factor in your view?
Yeah, no,
I mean, it seems like the risk reward for treasuries is much better.
Well, I wouldn't quite put it that way because, you're still talking about less than 4%. That's not a great return in the long run. But I will say that for right now, high quality fixed income looks, better priced than it has been for many, many years. So this is the one year in which I probably wouldn't be underweight bonds.